Hi, I'm Joshua, and welcome to my screencast about analyzing receivables. Receivables are the money owed to a company by a customer who has purchased the company's product or service. Receivables, also known as accounts receivable, is recognized by a company as an uncollected sale, and therefore, companies are generally interested in how well they are able to collect its receivables. As a result, companies are able to better determine whether receivables have increased or decreased, how often receivables are collected, and the number of assets comprised of receivables. For the following examples, we will introduce Mary, who runs her own beauty business. The horizontal analysis is a method used to calculate the dollar and percentage change in receivables from the current and previous year. Mary knows her total accounts receivable for the year in 2018 and 2019. To conduct a horizontal analysis, the prior year receivable balance is subtracted from the current year balance to yield a dollar change of $300. This amount is then divided by the previous year's balance to show that the accounts receivable has increased by 33%. Another method of analyzing receivables is through vertical analysis, which can be used to find and compare accounts receivable as a percentage of assets. For example, Mary knows her total assets and receivables for 2019. The accounts receivable of $1,200 is divided by the total assets of $30,000, which shows us that 4% of Mary's assets were receivables that year. Receivables turnover ratio is another method of analyzing receivables that compares a company's credit sales during a period to its average receivable balance during that period. In short, the higher this ratio is, the more times the company collects its receivables. Example, if Mary divides her credit sales by her average receivables, we can see she has an approximate receivable turnover ratio of 29. This means that Mary collects her receivables 29 times within a period. From this, we can also determine how many times this happens in a year. Therefore, we can use the days in receivable ratio, which equals to 365 days, divided by the receivables turnover ratio, revealing that Mary collects receivables once every 13 days. Analyzing receivables, we can also use the allowance ratio to determine the percentage of receivables that are expected to be uncollectible in the future. In Mary's case, this can be found by dividing her allowance for doubtful debts by her gross receivables. Thus, we can expect 7% of Mary's receivables to be uncollectible. To summarize, analyzing receivables can be performed through 5 different methods, which are horizontal analysis, vertical analysis, receivables turnover ratio, days receivable ratio, and the allowance ratio. Thank you for watching.